Hello, hello. Welcome back. My name is Kristen. I'm an authorized infinite banking practitioner, and I help Canadian families and business owners reclaim control of their money, create financial peace, and live the abundant lives that they were meant to live by keeping more of their hard-earned dollars working for them. Now, if you've seen my previous episodes, you know that I help families and businesses, and I really help you take over that banking function starting from whatever point that you're at. So often with families, we're starting at a point where they maybe have high interest debt, maybe they have credit card debt, maybe they have a car payment. We're looking at putting cash into their policies where we're going to save the cash in a place that they own and control. And then we're going to leverage that policy to be able to take over some of these higher interest debts so that the client can start paying themselves back into their own policy where they're going to have access to those same dollars over and over and over again. And of course, they're not interrupting the growth that's happening from them just putting their deposits in. So I really want to kind of look at a really basic level because often people can't really wrap their head around why they would want to use the infinite banking concept. Why is it important to take over that banking function? So I want to kind of give you a little bit of a picture here. The average income in Canada is about $68,000. So if you have a family with two earners, they're making about $136,000 a year. That means they're paying about $48,000 in taxes alone. Their after-tax income is only about $88,000. Of that $88,000 of after-tax income, how much of that are they losing to interest that's being paid out to big banks? Well, let's see. If we just look at the average household, they're losing $21,000 a year on mortgage interest alone. Another $2,000 on just one car. Imagine if you had more than one, and various loans, credit cards, all those kind of things. I'll say about $3,000 is average. Now, those same people that are losing $25,000 a year in interest, that's more than 29% of their after-tax income. Those same people are only putting away somewhere between $5,000 and $8,000 into savings, and they're chasing a return there. And so we're putting that money away into savings to save for retirement. But we need to solve for the problem of all the cash we're losing today. If we start solving for that problem, if we're able to start recapturing some of that interest that's being paid out to someone else and making someone else rich off of your back, if we can start recapturing that, you are going to end up with way more life insurance than any insurance company will ever approve you for. That's when we start talking about expanding your systems. And at that point, that's when we start looking at adding policies. Of course, we're going to add as much as we can on yourself and your spouse. We start adding policies on the kids. We start adding policies on grandkids, in-laws, business partners, you name it. Anyone that you have a financial interest in is someone that you can be insuring. And so going back to the basics, we're starting a policy on just the husband and wife in this family. If we're able to save them that interest, so that $25,000, if we can start redirecting some of that cash flow back into their pockets, like I said, their system is going to eventually get so big that they're not going to have anywhere to put it. So that's an amazing problem to have. But before we get to that point, way before we get to that point, you're going to hit a point where you have paid off your debts. You've paid off the high interest. Yes, you're financing your own cars. You're financing your own houses. Inside your family system, you're able to finance maybe the houses for your kids, but you're still going to have excess capital sitting inside of your policies. And what have we learned about money? We've learned that in order for it to grow, it has to stay in motion. So money sitting inside of your policy, available to you without you using it, you're leaving money on the table. You're not using it to its full potential. And so I really want you to start thinking today, even if you're just thinking about the infinite banking concept, you're wondering if it's right for you, or maybe you're a client that has just started and you're starting to take over some of those debts. I want you to start making some action plans today so that when the time comes in the future, and I promise you it's going to be sooner than you think, When the time comes in the future that you have excess money sitting in your policies that you are not employing to use in your day-to-day life, what are you going to do with it? I promise you, when you have access to capital and you have cash sitting there, all of these opportunities are going to come flying in. When you have access to money, opportunity just finds you, okay? What I want you to do is be able to discern when an opportunity is worth you investing in. So now is the time to start reading, start learning about investing, learn how privatized banking really works. I have some great resources in the description. I have some free resources that I can send you that are amazing. My favorite books and my favorite podcasts that I like to listen to. Robert Kiyosaki, amazing. If you haven't read Rich Dad, Poor Dad, I highly recommend you read that. I love his cash flow game. If you can get your hands on the physical game, it's so fun. Sit down with your friends and you really start to learn about how money works and how cash flows. Why cash flow is so much more important than how much you owe. If you can't get your hands on a board game or if you're not sure where to start, you can go to the cash flow website and you can look up the cash flow game and you can play it for free. You can play it with anybody in the world. You can join a game that's already started. You can even play it by yourself. I've done that a lot. Just sat down by myself so I can whip through it quickly. And every time I play it, I learn something new about how I'm thinking about money and how I'm thinking about investing and ways that I could have made the game work better for me. So awesome game. Highly recommend you check it out. You also want to learn how investments work. What kind of investments feel really safe for you? I'm not suggesting that you take your policy and go invest it into mutual funds. You're chasing a return that may or may not be more than what you are going to be paying in policy loans. My suggestion for investing, and this is not investment advice, guys, I'm just suggesting that you start learning about things that would help you create more cash flow into your life. So look at businesses, look at things like, I know people who do vending machines, look at rental properties. If your area isn't a good area for rentals, then look at a different area. Start learning about these things. If you want to get into real estate, you want to start taking courses, start networking with people that are already in real estate and start learning from some mentors. There's a ton of free resources online. If you just hone in on one area to start, one area. Another great one is Cody Sanchez. Cody Sanchez is always teaching about buying boring businesses. I've never thought that I would want to own a laundromat. After listening to Cody Sanchez, I'm thinking maybe I do. She buys boring businesses because that's what drives America. She has a ton of free resources. And once you've looked into the free resources, then you can start deciding which ones are worth maybe paying more for. Maybe you're ready to jump into a mastermind. Maybe you're ready to work with a mentor. Start learning about the things now. Your first investment that I want you to make is in yourself. I want you to learn as much as you can. Then once you have access to this capital, you're going to know where to put it. You're going to feel comfortable when these opportunities come to you. Another great example, if you want to get into real estate, but you don't want the headache of being in the actual transactions and the finding and all those things, maybe you just want to be a private lender. Maybe you want to look at like a private lending club. There's lots of communities out there that are there solely for the purpose of connecting private lenders with people who need it. There's a ton of ways that you can start employing your cash. I've heard of people flipping bulldozers. Like there's just so many things that you could do. And so start learning about different things that you can invest your money in. Start learning about how the world works. Start looking at people who are living the life that you want to live and start following their actions. Just start repeating their processes. Learn from them. Learn where they learned how to do it. Nobody was born knowing everything there is to know about investing or about real estate or about business. Whatever it is that you are interested in, start learning about it. So going back to using your family banking system, you can start there. You can start by just expanding who you're giving access to your system. Okay? Your kids are covered, your spouse is covered, they have policy loans available for them when they need it, but now you have more cash that's not being used. What do you do now? Well, maybe you have a cousin, maybe you have a neighbor, maybe you have someone, obviously someone you trust, and obviously you want to do this in the right way. You want to make sure that you're drawing up an actual loan agreement and that you have the terms set out, but maybe you want to start private lending in that way. Maybe you want to start doing something like investing in someone's business, someone that you know. Maybe one of your family members is starting a new business. Maybe they're looking for capital just to get it up and running, and you can have some creative financing terms there. Maybe you're a mechanic and you just want to buy a used car, fix it up, and then flip it, resell it, and make a profit. Guess what? Once you do that, you can take that cash, put it back into your policy, and then reuse it again to buy the next flip. Now you have room in your policy to buy 2 cars. So now you have 2 cars. Once those cars sell, now you have more room. And so the more you multiply what you are doing on the outside of the policy, the more you can multiply what's going on inside of your own policy, inside your banking system. So let's go back to talking about our family banking system for a moment. So when you have your system, and we've had the policies on the parents, now we have policies on the kids. Let's talk about when it's time to transfer the owner to the kids. First of all, how do you know they're ready? We do not want to be transferring ownership of an asset like a life insurance policy to a child who doesn't understand it, or an adult for that matter. Some kids understand it at 18, others maybe not at 40. They might not understand it their whole life. You might want to stay the owner. As the parents, you could stay owner of that policy right up until you pass away. At that point, the ownership can then go to the child. In the case that the child is not able to handle their own finances, you might have a contingent owner. You might have someone else there to steward that for the child. Because the last thing that you want to do is to put all this time and effort into setting up a system like this for a child that's going to look at it when they're 20, 21 years old and say, oh, there's a $20,000 cash value. Like, I could take $20,000 today and it's not a loan. I could just take that today and cancel my policy. I'm going to do that. You want to wait until your child understands that yes, they could do that, and that is a terrible idea, because when they can access the same amount of cash through policy loans that they own, that they control, and that they don't have to go beg the bank for money, their cash is still going to continue to grow for the rest of their life. So when they can see that the growth is still going to happen, even though they have these policy loans, even if they have a couple rough years, they can use this policy to get them through it. Then later on in life, they're going to be so glad that they kept it going instead of just canceling it out. And I'm telling you this because I would have been that stupid 20-year-old that would have said, oh, well, I need $20,000 today. I don't want to borrow it. I don't want to have to pay it back. And I would have canceled the policy. And so I'm telling you this from parent to parent. Please make sure that when we transfer our policies to our kids, that they understand what it is and they understand how it's going to work and how it's working for them. So we really want to be the person that's guiding them. And I'm more than happy to do this with my clients. I sit down with my clients and their kids, and we just set out their plan, and I help them every step along the way. That's my job. That's what I'm here for. I'm here to be your resource, both to help coach your kids and to coach them myself. And I can tell you that by far one of my favorite things to do with clients is to sit down with their kids and show their kids what this can look like. I'm sitting down with like an 18-year-old and showing them what this can look like if they keep saving just a minimum amount, a reasonable amount for the rest of their life, what it can look like when they're saving inside of a policy and they still have access to it. It blows their mind when they realize that they can put money aside here. It's saving for their future, yes, but they still have access to it if they want to open a business or if they need to buy a car and they don't want to have to go to the bank. So many options are opened for them when they have this, and it's so exciting for me to be able to sit down with a family and discuss this together. So if we start looking at what the average family is making and what the average family is saving, if they are able to save even that same amount, that $5,000 to $8,000 into their policy a year, and now they have this policy that's been building up through their life, by the time they're in their 20s, they have access to quite a bit of money there that they don't have to go to the bank for their car loans. They don't have to go to the bank. They don't have to worry about what's going on with investments and what's happening in the market with their mutual funds, because they have a financial structure that's guaranteed to be growing for the rest of their life, that they don't have to worry about these dips at the market or what's happening with the financial system. They have this stable foundation, and anything that they do over and above that, it's supporting. So having your policy underneath you is supporting these things like starting a business. This is your emergency fund. This is where you go when you need bridge financing between this business venture and that one. This is where you go when you're looking for something to help you get through that real estate deal. So when you have kids and we have policies on the kids, just make sure that you're talking with them. Make sure that you are, you're explaining what you're doing with your policies, how it's working, where you're using them. Talk about investments that maybe didn't work for you. Let them learn from that. I don't know when it became taboo to talk about money, but we should be talking about money in our family units. We should be helping our kids learn these things. We should be helping them learn not just to budget, because that's limiting what they believe they can do. We want to help them learn how to manage cash flow and how to keep their money moving for them for the rest of their lives. And so when we start looking at a family system, we've talked about the parents, we've talked about the kids. Now what happens as we start moving through generations? Now that kid is grown, now we have grandkids coming in. So now we want to make sure that we're putting policies, one, on those grandkids. We want to have coverage on them. Obviously, if we're all into this, we understand the power of having insurability locked in. We understand the power of having these systems starting when you're young. Once we have that in place, what happens now when that older generation passes away? Well, your younger generation is going to have policy loans. That's what we're doing. We're using our policies to fund the business ventures, the real estate investors, the businesses, all of these things. We're buying houses, we're holding mortgages for our kids, right? We have all of these things inside of our family systems. That means that we have policy loans. And so when the parents pass away and there is death benefit, even if they've maxed out their policy loans on their retirement, there's still going to be death benefit there that passes down to the next generation. We need somewhere to put it. And so when we have these policy loans, that's a great place to put it, where they're going to have access to the cash all over again. We also want to start putting that into more insurance. Use that money, keep it tax-free. One of the worst client stories that I have heard to date was a woman that her husband passed away and she received this great big death benefit. And her financial advisor advised her to put it into an RRSP to save for her future. Now, I completely agree that she needed to save it, or she would have spent it. It needed to be put away somewhere. But by putting it into an RRSP, she now turned that entire tax-free death benefit, it was about $1 million, turned it into taxable income immediately. If she wanted to cash in any of those RRSPs, she would have paid tax on the full amount that she pulled out. That was not fair to her. It's not fair to her kids, because when she passes away, half of that is going to be taxed by the government. And it wasn't great advice. So meanwhile, if she had a system like this set up, where she had her own policy that she maybe had policy loans in, her kids had policies, her kids maybe had policy loans set up. Now there's grandkids. She could have put money into her policy. She could have put extra into premium. She could have paid down her policy loans. Her kids could have put cash into premium. They could have put cash into policy loans. Her grandkids, maybe she could have started policies for her grandkids. Maybe she could have put it into a TFSA. All kinds of different ways that this could have worked, where it would have kept that money tax-free for the rest of their lives instead of becoming a taxable income for the rest of her life. I'm telling you this not to scare you. I'm not saying that RSPs are terrible. They're just knocking the tax can down the road. And so you need a plan to pull it out before the worst happens and the CRA gets half of it because they count it as income in the year that you pass. Just something we want to be mindful of. So when we talk about like the Rockefeller Waterfall method, that's basically it. You have insurance policies on the parents, you have insurance policies on their kids, and then on the grandkids, and so on, and on each generation. As one generation passes away, we put more cash into these policies, and we live off leveraging the policies for the things that we own. So we're going to leverage the policies to buy cars. We're going to pay it back. We're going to leverage the policies to buy businesses. We're going to pay it back. And so on and so on and so on. I hope this episode was helpful. I hope it gave you some new insights on how you can prepare for the times when you are going to have excess capital sitting in your policies and you want to employ that somewhere. So thanks so much for joining. If you found this episode helpful, please give it a like and hit subscribe. When you're ready to take the next step, click the link in the description to access my free resources and to book your free discovery call. Your future self will thank you. Until next time, live free.